So I'm sure you have been looking around. What should you be using the stochastic indicator for? What should you be setting the indicator up with? And how should you be using it? In this video, we're going to show you just that. Okay, so today, like I said to you, we're going to be talking stochastic indicator. The main reason why I actually am doing this video is because someone actually asked me, please can you show me how you set up the stochastic indicator and how you use it. They watched my previous trading strategy video. It's one of the major strategies that I use and I teach my students in the Training Academy. So make sure to find it on my YouTube page. As you can see right over here, Forex trading strategies all Forex traders should use. In that video, I basically used the stochastic indicator. So he was talking to me and he said, please can you show me exactly how you're using it just by itself and not with the MFI strategy. So that strategy is called the MFI strategy. Make sure to have a look. But he just wanted me to do a video talking about the stochastic indicator alone. So number one, the stochastic indicator is a very, very simple indicator. It basically is a momentum-based oscillator that helps us identify the overbought and oversold areas of the market. It's a very simple and straightforward indicator to use. I really don't apply too many indicators. I use a stochastic, the volume indicator, sometimes I use the MFI, and then I apply EMAs just to be able to identify trends and trend crosses. Very, very simple and straightforward. But that's mainly because most of my trading takes place using fundamental strategies and macroeconomic strategies. But these indicators at least help me to spot the larger time frame trends. So basically it's allowing me to identify where the market is moving over the longer term. So when it comes to the stochastic oscillator, there are thousands of articles online about how you should be using it, what you should use it for. The stochastic oscillator itself is quite a complex system, an indicator that people use to calculate. So I'm not going to dive in too much about it. What I'm going to do is basically just show you the simple calculations that I use, so how I actually set it up, and then I'm going to show you exactly how I use it and how you'd be able to use it as well. So basically, just to get started on this, I've got a simple MetaTrader platform set up. So if you're using any other different trading platforms, sorry, but best thing I can say is make sure to use the MetaTrader platform. I prefer using it. I've used quite a few different trading platforms and I prefer MetaTrader. So basically on the bottom level here, you can see this is the stochastic indicator and this is the stochastic indicator itself. So I'm just quickly going to delete this indicator and show you how to put the indicator up. So all you're going to do is go to the toolbar, you're going to click insert, go to indicator, you're going to select oscillator, and under oscillator, you're going to see that there'll be right at the bottom, the second last option says stochastic oscillator. So in the stochastic oscillator, I've already got it set up, but basically all you're going to do is have a percentage K period that you're going to set to 14. What this basically means is going to average out the trading progress of the last 14 periods. And the D period is going to average out the progress of the last 3 periods. The slowing is going to be set on 3, you can leave it there. Your price field needs to be the low to high. So the low to high basically means the highest point of that price and the lowest point of that price. The open to close will not consider the wicks of each end of the candle, which is not necessarily good. The wicks of the candle are also very, very important to use, and especially when you're on the larger time frames and you have extremely big wicks, the stochastic wouldn't consider that. So please make sure the price field is low to high. The MA method, just keep it on simple. Using any other different type of methods, there's not much of a reason behind it why you should be using it. And set the fixed minimum to 0 and the fixed maximum to 100. Now, in terms of colors, you can choose whatever you want. I just use black and red for the main and the signal candle. And then for the levels, what I use is level 80 and level 20, but then what I also add in is level 90 and level 10. So what you can do is just click add on the right-hand side and it pops in a level, and then you can add in whatever number you want. So basically, that's also very important to include. I also just leave the levels on blue. And then in terms of the visualization, just keep it on all time frames and say show in the data window. So when you click OK, you're going to have the stochastic oscillator pop up on your screen. Now, a lot of people don't necessarily know what they should be considering overbought and oversold. Now, here's where the difficulty behind the stochastic oscillator comes in. A lot of people will see someone like myself using the stochastic oscillator and think that it's a really easy and simple strategy to use, and they'll use it on any time frame. Now, something that I really can't translate or will struggle to translate over to you is that the stochastic oscillator sometimes doesn't work very well on smaller time frames. So let's say, for example, we've got a pair that is trending incredibly fast in a certain direction. It can stay within that overbought region for a very long period of time. So just to quickly give you a overview of the stochastic oscillator itself, so we're both on the same page. The stochastic oscillator has two levels, overbought at the top and oversold at the bottom. Now those levels that we put in, you can see over here. So what I'm going to do is just go back into the bigger time frame, just to give us a bit of a starting point. This level here is what we consider overbought. So overbought means the price has moved too high and we expect price to come back down. On the opposite, when price moves into this lower area here, we know that price has moved too low and we expect it to retrace and move higher. So overbought and oversold. In the center area here, between those two levels, we just call that price movement. So that's price movement of the indicator. We wouldn't consider any of those levels overbought or oversold or even sometimes significant in any shape or form. We're only looking for the overbought and the oversold regions. But just going back, when I said the smaller time frames tend to be very difficult to identify overbought and oversold. That's what I'm going to show to you now. And then we're going to work into the bigger time frames, and I'm going to explain why the stochastic indicator should only be used for the larger time frames and not for the smaller time frames. Okay, so now we're back in the 30-minute time frame. But as an example, what I'm going to do for you is show you why when you see price moving into that overbought region, it might not pull back on the smaller time frame, and that's what I'm going to show to you now. So a great example is over here. So let's have a look, and I'm going to use a vertical line. So right over here, we see price moves right into the overbought region, okay? So on the 30-minute time frame, your spreads are a lot tighter. You're not going to get a massive amount of profit from the position. So, you know, if you're not lucky, you could miss your entry point, you could get in early, and you might not land up moving that position back into a profit, and you might have to take a loss. So as you can see here, the position moves slightly back, slightly lower, but like I said to you, if you didn't catch the top of that, you would struggle hugely to make a profit. Position moves slightly back and then keeps on trending up on this very, very strong trend. But now if we take an example and we move to the larger time frame, you can see right over here, the stochastic oscillator on the hourly time frame never moved into the overbought region. So that would be an example that, okay, the 30-minute says it's overbought on that red line, but the hourly does not. So the larger time frame is saying no when the smaller time frame is saying yes. So if you traded on the smaller time frame, you would have been wrong. Now, you can see over here, let's move this, let's make a second red line. You can see it becomes overbought on the hourly over here, where the price still continues to go up. So the 30-minute is the very left line, and the second line is the hourly line. Now the hourly line says overbought, but the price never pulled back. So let's go into the bigger time frame. We go into the bigger time frame over here, and we identify that at both points on the 4 hourly, price never moved into the overbought region. It never did. So here's the challenge, and I've just picked this out. I mean, I didn't even actually look at this before filming the video. This is the first example where the 30-minute said on the first line, yes, it's overbought. It wasn't. The price kept on moving up. The second line was the hourly, where it said, yes, it's overbought. It wasn't. It just price kept on moving up. The 4 hourly is not overbought on either levels. So what that helps us identify is that the price on the larger time frame was never overbought. So being able to use the larger time frame to identify overbought and oversold regions is much better than using the smaller time frames. Okay, so what I've just done is jumped onto a brand new chart, and I'm going to now have a look at possible levels where we can see price has moved into the overbought region but has not actually moved bearish. So let's just jump onto a good example over here. Okay, so as you can see over here, we've got price moving into this overbought region on the 15-minute time frame, and we can see here the price continues to move higher regardless of the fact that the indicator says it's overbought. Now, a rookie trader would look at this position and go, well, the price is overbought, let me short sell on this position and just hold it to the downside and make lots of money. But on the 30-minute time frame, the indicator might not work very well. So let's look at the hourly time frame and see what happened there. You can see on the hourly time frame, it just became overbought, but stayed completely overbought, and price just continued to move higher. So the hourly time frame would have also been wrong. We move to the 4-hourly time frame, you can see the 4-hourly time frame identified it perfectly. So if we have a look over here and we go to the 4-hourly time frame, you can see that price peaks at this almost the exact same level where price on the chart peaks as well. So the price on the indicator and the price on the chart was near perfect. Now, this won't happen all the time, but what I can confirm with you is, let's say 6 to 8 times out of 10, if you are trading the 30-minute time frame and you try and go with that indicator, let's say the indicator says it's overbought and you go in the opposite direction, there is possibly a good chance you will lose that position. Now, on the hourly time frame, there is a lower chance of failure, but there is still a medium chance of failure. Let's say 5 out of 10 times on the hourly time frame, you will be wrong. On the 4-hourly, that chance of failure goes down slightly. There is a higher chance that you are correct. Now, as you can see, we can go on for examples for absolute days on this, but the higher time frames have a stronger justification of overbought and oversold errors. So let's take it, for example, to the weekly time frame. The weekly time frame would be very nice to have a look at. Okay, so now what I've done is I've gone into a brand new currency pair. I'm just throwing out these charts as I go, but I've gone onto the weekly time frame now because obviously what I've just shown you is the smaller time frames have a less possibility of or probability of success. So if you have a look on the larger time frames, on the weekly time frames, let's identify the levels where the market has been overbought. So let's have a look here. You can see there's another level over here, another level over here, and even the oversold regions. So you can also see there's levels over here. Now, when we have a look at these levels, we can go and take our vertical line and we can draw on the chart exactly where these levels were at. So you can see there, we have got some very, very strong levels. Now, as you can see, let's have a look on this level here. Okay, we can see price has pulled back near perfectly from that level. Lower level over here, you can see price has moved all the way down, and right at the bottom of this level, at the bottom of the trough here, you can see prices retraced near perfectly. Once again, on this level, you can see prices moved overbought and pulled straight back. Once again, prices moved overbought, pulled straight back. Right over here, prices moved oversold and pulled straight back. So as you can see on the much larger time frames, the weekly time frames, you can identify the trend. So you can identify when the bigger time frame is overbought or oversold. So let's say, for example, this time frame is extremely overbought on the weekly chart, but you go onto the 4-hourly chart and you see an opportunity to buy on the position. So you know the bigger time frame's already overbought, but now your mind is saying to you, I should buy on the smaller time frame. That makes absolutely no sense because you're going against the probability that the market will pivot and move against you. So what you should be doing is finding the larger time frame, knowing where the market is going to be going. Let's say the market is overbought and you know the market will probably return and it will turn bearish. Then you know on the smaller time frames, you should only be short selling any asset classes with those levels. Now, this is general knowledge. This makes sense. Now, the problem is that the challenge behind this is this all makes sense, where we're saying to ourselves, this market is overbought. We should be short selling it. Younger traders, sometimes rookie traders, people who haven't been trading for long, they'll go into the larger time frame and they'll see that the market is overbought and it's probably going to move bearish. But then they'll go into the smaller time frames and they'll see an opportunity to go and buy something, so expecting that the price is going to move higher, and they'll go and trade that, even though they know the weekly time frame, the bigger time frame, might probably turn bearish. So they are going against the larger trend. Now, this is what the stochastic oscillator should be used for. It shouldn't be used for the hourly time frames, the 30-minute, the 15, the 10-minute, whatever you think it should be used for. It should be used for the daily, the weekly, and the monthly time frames. Now, I know there are people out there that say to me, I've traded on the 15-minute and I've had success. I've traded on the 30-minute and I've had success with the stochastic oscillator. I can tell you that right now, that is just traders' bias. They're just being lucky. And I can tell you right now, over the long term, trying to use an indicator like this, trading on the 30-minute or 15-minute or hourly time frame, is not going to work, because far too many times they are going to be caught by major uptrends and they're going to land up losing more than they make. Now, what I can say to you is I've traded the stochastic oscillator on the larger time frames probably over maybe 100 to 190 trades over the past 3 to 4 years. And that's basically, those are trades just using the stochastic oscillator and applying other fundamentals and macroeconomic strategies, but purely just using it to identify, oh, the market's overbought, oversold. And I've had success almost every single time. My profitability ratio sits at 85% profitability, and I have verified track records to show you that. And not just for myself, I know many other traders that use this indicator on the larger time frames. They have the same track records. They have very similar success rates using it on the larger time frames. The smaller time frames, you're gonna get caught out and you're gonna get nailed. So once again, everyone, I really hope this helped you understand a bit more about the stochastic oscillator, how to use it and how not to use it. If you do want to get more educational content, make sure to follow to our channel. I've got tons of videos uploaded, educational content about trading and investing that I'm sure you'll like. Once again, I'll see you in the next video. Cheers for now.